The market has continued its tremendous rally. And while I don't think there's inherently anything bad with continuing a rally, I think this rally has gotten quite strong and we're quite close to new all-time highs. A little too close for comfort. I talked to one of my friends who's very involved in real estate this weekend. He asked me about the markets. We were talking about real estate, forecasting rates, etc. He said he had 100% certainty that if rates rise, real estate will fall. And I think that concept is somewhat applicable to stocks, but we're not making our decisions and our forecasts exclusively on rates. There's obviously a lot more nuance in the market. And as Jim Cramer says, there is always a bull market somewhere. And we're going to get into these divergences and where we can spot these types of things today. But I want to begin with today's more specific moves. Yesterday at night, we saw the futures down. I expected that to continue. And then Elon comes in, buys a stake of Twitter. Personally, I love that decision. Very happy to see him involved in Twitter in that way and see some more balance in the force. Always welcome, in my opinion. But futures then went up. And this was not a typical day in the market. We had quite a strong divergence between the NASDAQ and the Dow. Quite a strong divergence. Look at those numbers. They're quite strong. The NASDAQ did lead on the downside and is leading on the upside, but the Dow is really it did okay on the downside. Not nearly as bad as the NASDAQ, but it's really struggling right now. And I think I don't think we're going to have the same market if we get to new highs that we had when we were at the previous highs. I think there were many stocks that were too expensive then, and those are the stocks doing the best. In some cases, they were the worst and shouldn't have been the worst and should maybe now be the best. But there's not enough divergence. There's not enough specific choosing of specific names. And I think this whole basket moving is quite concerning. So I'm getting a little cautious about the current levels of the market, and I'm nibbling on downside protection. I'm not adding to positions. I have plenty of positions, and I want to get a little more specific with what I mean. The basket, the entire NASDAQ, all components, or virtually all components of this basket, rising all at once and falling all together. I think that needs to end, and that's really where my concern stems from. Let me give you an example. I think companies should do well on their own merits now. I think rising rates are going to make us have to rationalize our investments. If rates are, let's say, 5%, well, that shouldn't impact a company that's growing 50%. But a company that's not growing 50%, that's growing 20%, or is quite large, is only going to grow for a few more years, that's a company that should be impacted by rates. For example, a company like Jumia has a fantastic day today. They give news pertaining to their future growth, a deal with UPS. That company should do well. That company should not fall off just because prices are expensive, because that stock is quite cheap. It individually is quite cheap. And I think that is something that's not taking place right now. And that's ultimately what my biggest concern is that all these stocks are rising in unison, and the stocks that are well priced aren't really rising in unison, and oil stocks are down, but oil prices are up. It's just, I don't like the look of this. I don't like the look of this. And sure, it's going to be okay today. Maybe it's going to be okay tomorrow this way. Maybe even the day after that. But I'm not playing the day to day. I'm not a day trader. I do place short-term trades, typically in SPY put options or SPY call options, etc. But I'm not a day trader. And in the week to week and month to month, I think we're getting closer to a local peak. Not saying new all-time highs. I'm saying a local peak. We're too close to all-time highs. Maybe it's time to give some back. Maybe it's time to start focusing on individual names again and their own individual merits, like Jumia. Not everything being caught up and just levitating altogether. There's a ceiling somewhere. There's a maximum price. And you best believe yields are going to affect that. Look at what Jamie Dimon said today. Quite negative, quite rational, not necessarily focusing on one piece of news, or the NASDAQ moving or anything like that. Focusing on rates, what they mean for market dynamics. And this is really important. I'm just going to reiterate it. Market dynamics. Sometimes market dynamics don't matter. For example, quad witching, not really fundamental. Oil contract expiry days, not really that important in the long run. But a market dynamic that is important is supply and demand. If you increase rates, you increase demand for bonds because they give you a better return relative to stocks. That's going to take supply of investment dollars away from stocks, which is going to decrease price. I don't know exactly how that looks on the supply-demand graphs, but that's what happens. When you increase rates, you increase demand for bonds, and you decrease demand for stocks, and bonds become more attractive. That's just the way it is. So rates are coming, and they're coming higher, and we're seeing them come higher today, and it's likely going to continue. Jamie Dimon is saying that the market doesn't even forecast where they're going properly. He thinks they're going even higher. And yes, he does have financial incentive to say that. He will benefit from higher rates, but they're forecasting pretty high. And something that I think is important to note is in the last Fed meeting that caused this market to rally, the Fed said essentially 25 basis points the rest of the year. Daly, D-A-L-Y, Fed member, said yesterday, I believe, 50 basis points looking more likely. I think a lot of people are saying that. If the Fed was saying 50 basis points at the last meeting, would we have this same rally? I'm not sure, but they're saying it now. And I think we have to take note. And I think when that meeting comes, it may have an impact. We'll see what happens. I'm not nibbling on the upside. How am I positioned? I've got 20% cash, got about 5% downside protection, SPY puts, WeWork short, etc. I've got about 10% energy, 5-10% materials, those types of companies, and the rest in super cheap growth companies that I like, and bond yield shorts. And I'm feeling okay with that portfolio mix. I'm not anti-long, but I'm cautious. And I would not be without downside protection right now. Typically, I don't typically say that. But right now, we're getting pretty close to all-time highs. I don't think all-time highs are warranted right now. That's my take. We'll see what happens tomorrow. Until then, peace out.